Markets are addicted to the short term. A rate decision, an inflation print, an election result, each is treated as if it were the whole story. But the forces that decide whether a currency keeps its crown, whether a debt load stays sustainable, or whether a great power holds together, move on a timescale of decades. They turn so slowly that almost no one alive has watched a full rotation, which is exactly why each generation is caught by surprise. This is the territory Ray Dalio calls the big cycles. The recurring, almost mechanical patterns of rise and fall he traces across 5 centuries, from the Dutch guilder to the British pound to the US dollar. You don't have to accept every detail to find the lens useful. Its value is that it forces you to zoom out from the headline and ask a single question. Where in the long arc are we actually standing? The model rests on 3 cycles that turn at once. The first is the long debt and money cycle. The second is the internal cycle of order and disorder, how cohesive or divided a society is. The third is the external cycle, the rise and fall of great powers and their currencies. And what makes the framework powerful is that these cycles are correlated. A country that borrows too much tends, a generation later, to face widening wealth gaps and sharper political conflict. A weakening power eventually loses the confidence that underwrites its currency. Decline, when it comes, arrives on several fronts at once. We begin with a cycle that sets the tempo for all the others. That cycle is debt. Credit is productive until it isn't. Over a long expansion, often lasting 50 to 100 years, an economy accumulates debt faster than the income needed to service it. Central banks cut rates to keep the machine running. When rates reach zero, they turn to printing money and buying assets. Eventually, the debt burden grows faster than the economy itself, and the system has to deleverage through default, austerity, inflation, or some combination of the 3. The telltale signature of a late-stage cycle is a government whose interest bill starts crowding out everything else it wants to do. The United States is now well inside that signature. Debt held by the public crossed 100% of GDP in early 2026, a threshold last breached at the end of the Second World War, and gross federal debt reached roughly 123%. But more telling than the level is the servicing cost. U.S. net interest ran close to $950 billion in fiscal 2025, now exceeding what the country spends on national defense. This is not a prediction of imminent collapse. Deep, liquid markets and a captive base of buyers can sustain a heavy debt load for a long time, as Japan has shown for a quarter of a century. But it is the configuration the framework tells us to watch. Rising debt, a climbing interest burden, and a central bank whose balance sheet has become a permanent fixture rather than an emergency tool. Debt strains the machine. The next cycle decides how a society handles the strain. As an economy matures and the debt cycle ages, wealth and opportunity gaps tend to widen, and with them, the political conflict over how the pie is divided. Internal disorder tends to peak late in the long debt cycle, precisely when a slowing economy sharpens the fight over a shrinking surplus. Inflation is the quiet accelerant. When a government leans on printed money to manage its debts, the cost falls hardest on the young, the wage earner, and the saver, while those who already own equities, property, and gold are insulated or enriched. A rising cost of living is not only a monetary statistic, it is a distributional event. And distributional events are the raw material of political conflict. Demographics compound the strain. An aging population shifts the balance between workers and dependents, loads the pension and health systems, and changes the political arithmetic. Read the age structure, the inflation trajectory, and the wealth distribution together, and you get a reasonable gauge of how much cohesion a society has left to spend before the rules themselves come up for renegotiation. Internal strength, in turn, is what a country projects, or fails to project, onto the world stage. The external cycle is the grand one, the rise and fall of great powers and their currencies. A rising power educates, innovates, and competes better than its rivals. It wins a growing share of world trade. It builds the military to protect its interests. It becomes the world's financial center. And finally, its currency is adopted as the global reserve. Reserve status is the last thing to arrive on the way up, and one of the last to leave on the way down. That lag is what makes decline so easy to deny while it is happening. The dollar still dominates, but it is drifting. Its share of allocated global reserves sits around 57%, down from roughly 71% at the start of 1999, according to IMF data. The euro holds near 20%, the renminbi around 2%. Much of the recent wobble is a valuation effect rather than active selling, so it would be wrong to call this a collapse. But the direction across several decades is unmistakable, and it points toward a more multipolar reserve system rather than a single successor. Strip away the specifics, and every empire in Dalio's dataset moves through a similar arc, tracked with roughly 8 measures of power: education, innovation, cost competitiveness, share of world trade, military strength, economic output, financial center status, and reserve currency. On the way up, these reinforce one another. On the way down, the same loop runs in reverse, slowly and out of sync. Measured on output alone, the balance has already shifted. On a purchasing power parity basis, China's economy overtook the United States around the middle of the 2010s, even as the US retains the lead in finance, reserve status, and military reach. That gap between economic weight and monetary primacy is the space in which the next 2 decades will be contested. The reserve currency signal tells the same story from the monetary side, and its clearest expression is gold. Central banks have been accumulating it at an elevated pace for several years, and gold now makes up over 20% of official reserve assets. When the institutions that hold the world's reserves quietly rebuild their gold position, they are hedging the very system they helped build. This is not the same as abandoning the dollar. Most gold buying has not been funded by dollar sales, but it is a vote for optionality in a more uncertain monetary order. Every falling incumbent has a rising challenger, and today's is China. On output measured at purchasing power parity, it has already passed the United States. It is the world's largest trading nation. It is building the financial plumbing to conduct trade outside the dollar's orbit. None of this makes the renminbi a reserve currency. Closed capital markets and limited trust see to that. But it steadily reduces the world's dependence on the dollar at the margin, which is how these transitions always begin. Trade balances, currency crosses such as the dollar against the renminbi, and the production maps for critical minerals are where the external cycle is being redrawn in real time. 2 wildcards sit above all of this. Acts of nature, pandemics, droughts, floods, have repeatedly accelerated declines by forcing emergency spending onto balance sheets that were already stretched. COVID added years of debt to every developed economy in a matter of months. Technology cuts the other way. A genuine productivity leap can extend a cycle by lifting the growth rate that services the debt. Whether the current wave of AI becomes that kind of extension or merely another concentration of wealth is one of the genuinely open questions of the decade. So this is where a framework becomes a practice. Each cycle maps onto indicators you can follow directly. For debt as a share of GDP, the path of interest rates, the ratio of interest to revenue, and central bank balance sheets, read alongside inflation. For the internal cycle, demographics, the inflation trajectory, and wealth distribution. For the external cycle, each country's share of global reserves, official gold holdings, trade balances, and the critical minerals that underpin the next technological era. The aim is not to time the turn. Cycles are probabilistic, and the wildcards can bend the path. The aim is to know which era you are standing in, so the next data point lands as a signal instead of a shock. The big cycles are not a trading signal, and they are not fate. Empires and currencies rise on education, innovation, and trust. They fall on debt, division, and complacency. The dollar retains its crown, the machine is still turning, and nothing here is inevitable. But the signals worth watching are no longer hypothetical, and now you know where to look. This is Game of Francs. The full article, with the charts, the data, and the methodology, is at gameoffrancs.com. Subscribe for the next one.